Are you new to the world of investing and feeling overwhelmed with all the information out there? Don't worry, you're not alone. Investing can seem like an intimidating task, but it doesn't have to be. Whether you're looking to invest in stocks, real estate, or something else, there are some basic tips that can help get you started on the right track. In this video, we'll be sharing 5 tips for beginner investors that will help you navigate the investing world with confidence. So if you're ready to take control of your finances and start building your wealth, keep watching. Number 1. Start small and diversify your portfolio. One of the most important things to keep in mind as a beginner investor is to not put all your eggs in one basket. Diversifying your portfolio means investing in a variety of different stocks, bonds, and other assets, rather than just one or a few. This allows you to spread out the risk and increase your chances of earning a return on your investment. When starting small, you can gradually build your portfolio over time by investing in a few different companies or industries. This will give you a better understanding of how different investments perform and help you make more informed decisions as you grow your portfolio. By diversifying your portfolio, you'll also be able to reduce your risk of losing money if one particular investment performs poorly. Instead, the overall performance of your portfolio will be less reliant on any one investment. This way, even if one of your investments doesn't perform as well as you had hoped, the others may still be performing well, helping to balance out the overall performance of your portfolio. It's important to note that diversification does not guarantee a profit or protect against loss, but it can help spread risk and provide a potential for more consistent returns over the long term. Number 2. Do your research. Before making any investment, it's crucial to do your research to make sure you understand the industry, the company's financials, and the management team. This will help you make better decisions about your investments and improve your chances of being successful. When researching a company, it's important to look at a variety of different factors, including the company's financials, such as its revenue, profits, and debt levels. This will give you a better understanding of the company's financial health and its potential for growth. Additionally, look at the company's management team, including the experience and track record of the CEO and other key executives. A strong management team with a proven track record of success can be a key indicator of a company's potential for future growth. It's also important to research the industry the company operates in. Look at market trends, competitors, and the overall outlook of the industry. Investing in a company that operates in an industry with strong growth prospects and a positive outlook can increase the chances of the company's success. Moreover, it's important to pay attention to the company's financial statements, such as the balance sheet, income statement, and cash flow statement. These statements will provide important information about the company's financial health, performance, and future prospects. Research is crucial before making any investment. By understanding the company's financials, management team, and industry, you'll be able to make more informed investment decisions and increase your chances of success. Number 3. Have a long-term mindset. When it comes to investing, it's important to think about the long-term picture, rather than focusing solely on short-term market fluctuations. Investing is a marathon, not a sprint, and it takes time for your investments to grow and for you to see returns. By having a long-term mindset, you'll be less likely to make impulsive decisions based on short-term market fluctuations and more likely to make sound investment decisions that will pay off in the long run. It's important to remember that the stock market is inherently volatile and can experience ups and downs. While it can be tempting to react to short-term market fluctuations by buying or selling, it's important to remember that these fluctuations are normal and are not always a reflection of the long-term potential of a company or industry. By having a long-term mindset, you'll be able to ride out the market's ups and downs and focus on your investment goals. Additionally, having a long-term mindset allows you to take advantage of the power of compounding. Compounding is the process by which your returns on an investment generate returns of their own. This means that your money can grow exponentially over time, but it takes time for the power of compounding to work its magic. So by having a long-term mindset and a long-term investment horizon, you'll be able to fully take advantage of the power of compounding and grow your wealth over time. Number 4. Be patient, because investing takes time to see results. Don't expect overnight success. One of the biggest mistakes beginners make is expecting immediate returns on their investments. The stock market is a long-term game, and it takes time for your investments to grow. It's important to remember that the stock market can be volatile, and there will be ups and downs, but over time, the market tends to trend upward. It's important to have a long-term mindset when it comes to investing. Don't get caught up in short-term market fluctuations, and don't make impulsive decisions based on short-term market trends. Instead, focus on building a diversified portfolio of quality companies that have strong fundamentals and growth potential. Additionally, it's important to remember that investing is not a get-rich-quick scheme. Building wealth takes time and patience. It's important to stick to your investment strategy and not get discouraged by short-term market fluctuations. When you invest for the long term, you'll be able to ride out the ups and downs of the market and reap the benefits of compound interest over time. Number 5. Stay informed. Keep up with the latest news and market trends to make informed investment decisions. This means staying up to date on the current economic and political climate, as well as any developments within the industry or company you are considering investing in. Following financial news and publications, such as the Wall Street Journal or Forbes, can provide valuable insights and analysis on market trends and potential investment opportunities. Additionally, subscribing to financial news alerts or setting up Google News alerts for specific companies can help you stay informed in real time. Another important aspect of staying informed is regularly monitoring your portfolio. Keep track of the performance of the companies you have invested in and make adjustments as needed. This could mean selling underperforming stocks or reallocating assets to more promising opportunities. By staying informed and regularly monitoring your portfolio, you can make data-driven decisions that align with your investment goals. It's a good idea to get a good understanding of the different types of investments available in the market and how they work. For example, stocks, bonds, mutual funds, ETFs, options, etc. Understanding how these different types of investments work can help you make more informed decisions about which investments align best with your investment goals and risk tolerance. Congratulations! You've made it to the end of our video on 5 tips for beginner investors. We hope you found the tips helpful and informative. Investing can be a great way to build wealth and secure your financial future, but it's important to do your research and approach it with a solid strategy. Whether you're just starting out or looking to refine your approach, these tips can help you make smarter investment decisions. So take these tips to heart and start putting them into practice. Thanks for watching, and be sure to subscribe to our channel for more helpful content on investing and personal finance.